Hey everyone, important topic to discuss with you today. That's how to think about home price appreciation. So, you've probably heard the saying, your home is your castle. And if you're like most Americans, home equity, so the equity value in your home, is likely to be the single largest component of your net worth. And that's true across all age groups, from younger generations to older generations. So, naturally, most people want to see the value of their home go up over time. But the question is, by how much? What's a reasonable expectation? That's the question we're going to try to answer today. And to do that, we're going to take a look back at history. So we have data on US home prices since 1891. And since then, what we've seen is a rate of appreciation on a nominal basis. And nominal simply means not including inflation, so just pure price appreciation of 3.4% per year. Now, if we include inflation and we adjust for that, what we see is this drops to 0.5% per year. So 0.5% above the rate of inflation per year since 1891. Now, what should jump out here is that in very few calendar years is the appreciation rate anywhere near this historical average. So usually you have rates of appreciation far above it or below it, even negative. But these are the long term averages: 3.4% nominal, 0.5% real. And if we look at a chart showing you US home prices and inflation over time, what you'll notice is a pretty strong relationship here. There's a very high correlation between these two variables. They tend to move together over long periods of time. You don't often see a huge deviation one way or another where home prices are exceeding the rate of inflation or lagging the rate of inflation by a wide margin, and that persisting for long periods of time. And in fact, before the year 2000, we had never seen US home prices on a national basis exceed the inflation increase by more than 33% on a cumulative basis. And as a result, very few people thought of the house they lived in to be an investment that was similar to, let's say, the stock market or commercial real estate. But all of that thinking really changed with the housing bubble of the early to mid 2000s, when you had this rapid appreciation, not only in nominal increases, but real increases as well for the US housing market. And so as a result, all of the thinking changed. People now viewed housing not only as an investment, but the best investment you could make, because people were saying home prices never go down. So the stock market had gone down in 2000, 2001, 2002. Home prices are up in all three of those years. So people are saying housing is a new and improved stock market because prices never go down. And of course, what happened next? Well, prices went down. They went down every single year from 2007 to 2011. They went down 26% on a nominal basis, 35% on a real basis. And what you saw then was a mean reversion in this relationship between home prices and inflation, where it came down to back to a more normal level. But the story doesn't end there, and it's because the Federal Reserve and the federal government weren't happy with home prices coming down and being reflected by natural forces. They wanted home prices to go back up. So the Federal Reserve came up with this theory called the wealth effect. And what they said was, if we drive home prices up, people will spend more money, and that will be better for the economy, and so on and so forth. So they decided to leave interest rates at 0% for 7 years, from December 2008 through December 2015. And then when they hiked interest rates, they did so very slowly. And at the same time, they're doing multiple rounds of quantitative easing, buying treasury bonds, trillions of dollars, buying mortgage bonds, trillions of dollars, and they're driving down long term interest rates, trying to boost the value of home prices. The federal government's doing other measures. They're doing stimulus programs like the home buyer tax credit to encourage people to buy homes, drive up demand. And then, of course, in 2020, 2021, three different rounds of stimulus that put more money into people's pockets. That drove up the value of homes as well. And as a result, what we saw was the second housing bubble in US history take hold. And this bubble actually exceeded the prior bubble, where at the end of 2021, we saw home prices exceed cumulative inflation by 117%, which was a new record high. Now, 2022, things started to change. You had mortgage rates spike higher. Federal Reserve stops buying mortgage bonds. They start hiking interest rates. And so what you saw then was a collapse in affordability. where you saw the percentage of house payment as a percentage of median income spike to a record high above the previous housing bubble. That led to a collapse in demand for home buying. And what you saw in 2022 was actually the first real price decline in the US for homes since 2011. So the question you're probably wondering is, well, what does this history tell us about future home prices? What's going to happen in the next few years? And of course, in the next few years, anything can happen. We've seen this historically. We have these booms, of course, and busts back and forth. Anything can happen in a short period of time because there's so many factors affecting the prices of homes. So you have supply and demand, affordability, inflation, mortgage rates, unemployment rates, Fed and government policy. All of these things are filtering in to home prices, and it's impossible to predict how all of them are going to impact prices in a short period of time. So throw predicting prices in the short term out the window. But what can we say about long term uh, changes in the housing market? Well, what we can say is very rarely do we see a huge deviation from the rate of inflation over long periods of time. So if we're looking at 30-year periods, during the best 30-year period for the US housing market, we saw a 2.2% per year real price appreciation. So 2.2% above the rate of inflation. And in the worst 30-year period for housing, it's a long time ago, but it lagged the rate of inflation by around 2% per year. So over long periods of time, you tend to see this pretty close relationship between home price appreciation and inflation. But in the short run, anything can happen. And what's happened in recent decades is home prices have exceeded the rate of inflation by record amounts. And what's that done to expectations? Well, it's driven them way higher than they've ever been before. So there's something called recency bias, where us as human beings tend to assume that the recent past is going to be repeated in the future. And because the recent past has been so good for the US housing market, we've seen such a rapid appreciation, not only on a nominal basis, but on a real basis as well. We think that is going to continue again in the future. But I would caution those expectations and say that unless there's been a paradigm shift in terms of the laws of economics, which is basically comes down to supply and demand, unless there's been a paradigm shift, you're unlikely to see these real rates of increase persist in the future because there's a natural correction mechanism built into the housing market where if home prices go up too much, you see more supply come onto the market, so more homes are built or more people offer them for sale, or you can have a drop in demand. So if home prices go up too much, as we saw in 2022, you have lower affordability, a collapse in demand that can bring prices lower. So unlikely to see the rates of real appreciation persist that we've seen in the past few years into the future. So coming back to that question, if you just bought a home, how much should you expect it to appreciate? Well, if you're going to live in that home for a long period of time, let's say 20 or 30 years, your expectation should be probably not that much more than the rate of inflation in your area. So we've seen that historically, this close relationship. There's no reason to believe that it will change in the future. And you have to understand that it could very well be less than the rate of inflation. So if you're buying at a point where housing prices have exceeded the rate of inflation, well, then you can go a number of years where it corrects in the other direction. We saw that obviously after the housing bubble in the mid 2000s, and perhaps we're going to see that again today. So your expectations should be probably around the rate of inflation with the understanding that it could actually be less. Now, coming back to that idea about housing and housing that you live in as an investment, I think if you're going to evaluate as an investment that housing, you have to include all of the costs. So the price of a home is just one component. Obviously, you have mortgage interest, taxes, insurance, maintenance, capital improvements. A lot of costs go into home ownership. And if you're going to calculate a real rate of return on a home, you would need to include these other costs as well, which is probably why you shouldn't be thinking of your home as an investment in the same way you view your stock portfolio or commercial real estate or things like that. It's just a completely different animal. And if we included all of these costs, the calculation in terms of that rate of return becomes much more difficult, which comes back to that old saying, how should you view your house? Well, your home is your castle, and really it should be providing you benefits that are beyond just the numbers. So if you look at price appreciation, you talk about price appreciation, and you talk about owning a home and living there, price appreciation really, at the end of the day, is only one small part of the equation.